We are now joined by Santanu Sengupta, Chief India Economist at Goldman Sachs. And Santanu, thanks for waiting by patiently. We were talking to a management which was under a bit of a cloud and therefore important to get that out of the way. But thanks for being patient with us. And thanks for joining in today. Neeraj here, good morning. At the outset, Santanu, the whole mix of, or the whole piece of intersection between global rates and expectations thereof versus what India can do. Because thus far, India has done, or the RBI has marched to its own tune when it comes to the rate cut trajectory and not quite paid heed to what the Fed was doing. But now the Fed has cut once, expectations are more, but the inflation numbers not looking, or the affordability index in the US not looking that positive, and people are skeptical about that Fed rate cut trajectory. What do you think plays on the RBI's minds as they take a decision and communicate to us?
Yeah, thanks, Neeraj. So firstly, on the Fed, our house call still is that they cut twice more this year and then twice more next year. But I think the RBI, as you correctly pointed out, is going to look at the domestic growth inflation trade-offs to make their monetary policy call. Our sense is that this time it's going to be much more what the RBI assesses on the growth trajectory than on inflation, because frankly, inflation has been running at sub 3%. We think it will be sub 3%, in fact, closer to 2% for this quarter, and then probably rise a little bit higher into the next quarter. So really the decision that the RBI will be basing their monetary policy on will be where they see growth. Now, the domestic growth numbers are looking okay. You know, the previous quarter's growth came out surprisingly higher than expectations, both consensus and us. You've had the GST tax cut and the tax reform. All of that will feed into growth from this quarter onwards. We already have said that, you know, we think that a mass consumption revival is underway. And at the same time, you have these external headwinds from tariffs and then H-1B visas and so on. And therefore, I think that's really the mix that the RBI will be looking at before making their decision.
Okay, so that's with regards to what the RBI could be doing from here on. But, Santanu, Hiral here, the GDP growth in the first quarter of FY26, that has actually beat estimates, and that is what the monthly economic outlook for August indicated. With this, if you have to tie in the impact that we will see in terms of US H-1B visas, the trade tariffs, how big a risk will this be in terms of growth? And to add to that, the government's borrowing for FY26, that number will be is a number which is lower at around almost 14.72 trillion. How are you reading that?
Yeah, so firstly, on the growth mix, as I said, the domestic economy looks pretty okay to us. On the external front, I'll make a distinction between tariffs and H-1B. H-1B, we think the near-term impact is quite muted on the current account, because even if, let's say, some of the remittances is to sort of wean off, it'll be more of an impact into FY27 or thereafter. So the short-term impact, we think, will be quite limited. But as you've seen that markets have reacted to these news, you know, for the secondary tariffs of 25% that was imposed on the Russian oil purchasers, our call still is that this gets resolved by the end of the year, and some of that gets negotiated down. But the first 25% tariff still remains. So if you're an FII investor looking at India, then you have the first 25% round of tariffs, then the secondary sanction of 25%, and then the H-1B. And therefore, you've seen these outflows happening, especially on the equities front. That really is the headwind that India is facing right now, not so much from the growth drag that we are seeing immediately. The growth drag, if this is to remain for a long period of time, will come more later, will be coming later, probably likely in FY27, in our view. On the fiscal front, that's an interesting question. We think that the government will stick to the 4.4% fiscal deficit target, in fact, try to probably better it also. But the important thing is that you had seen a curve steepening, where the long end yields, especially from anywhere from the 10-year all the way up to the 30-year segment, had risen. the borrowing calendar is now indicating that some of the supply in that very long end tenor will be lower. And therefore, our call is that the very long end yields, which is the 30-year kind of segment, comes down. That will eventually lead up to financial conditions easing. That combined with one more rate cut, which we have in our view, likely the December meeting, our call is the RBI waits and cuts in December, should mean easier financial conditions going forward.
Okay. Shantanu, very lastly, in terms of if you talk about, from my side, the IIP data that did come in yesterday, mining has been strong, but there has been weakness on the consumption part of it if you remove the non-consumer durables. What is that indicating? And if a bounce back has to come in, taking GST cuts into consideration, do you think it could be a steep one in the month of September and October?
Our sense is that the consumption growth upside will be felt more in the October to December quarter. I mean, there'll be a little bit of growth upside probably in the last 7 days of the current quarter, which is where we are in right now. But the main growth upside will really be felt in the October to December quarter, which is when, so end of September all the way up to October, December quarter is when we would expect production numbers to start showing up. But remember, if you're talking about durables purchases, you could see that from a bit of imports as well. I mean, it does not necessarily mean that the domestic production has to show up immediately. So the demand that you're going to see, in our view, from about end September all the way up to the December quarter, will reflect in both production and import numbers in the following quarter.
Santanu, the other question is, in times which are as geographically disconnected as this when it comes to global growth, is this GST 2.0 move the last straw or the last hope for growth revival? Or do you believe it's it always is an ongoing process, but is there enough fiscal room to make an attempt for a capex push again if this doesn't give the desired results?
Interesting question, Neeraj. Our call is that whatever had to be done on the fiscal front in terms of fiscal impulse ammunition is pretty much done.
Okay.
You've had the income tax cut, you've had the GST cut. We don't think there's more fiscal space to do more. Can you look at structural reforms? Sure, yes. Can there be easier financial conditions through the monetary policy channel? Yes. Can there be ease of doing business? Yes. But fiscal impulse through further expansion of the deficits, we think is a no. I think the government, credit where it's due, I think the government has been extremely astute in terms of their fiscal consolidation path. They will want the debt to GDP numbers to align towards a more reasonable target by 2030.
I have one more question, Shantanu, and sorry if I'm not sticking to script. I know we had to discuss a note of yours as well, but this is very interesting for me, and hence I'm pushing this a bit more. The part two of my question is this. You've seen various economic cycles. You've seen India react to both capex push and consumption pushes. Do you think, in your wisdom, that this consumption push, coupled with the RBI moves as well as the income tax cuts, can bring back growth, give more tax revenues to the government to restart, if I can use that term, a capex push in FY27?
Look, our point is that capex had a huge upswing in the last 5 years or so, right? I mean, from the pandemic all the way up to FY24 or so, you saw 25% nominal CAGR growth. When your nominal GDP is growing at in the ballpark of 10, 11%, it's difficult to envision capex growing at double that rate or higher for a long period of time. So I think that growth is behind us. But remember, Neeraj, the base that you're working with is anywhere in the range of 10 to 12 trillion INR right now. If the government is able to grow that at a rate of nominal GDP growth rate, which means that capex to GDP is flat at around 3.3 to 3.2% in our view, even that will be a significant amount of money that will flow into the system, both in terms of railways or roads, defense, and so on. Remember, India is not short on savings. So the long-term savings right now that is anchoring the sovereign bond curve can ultimately be channelized into infrastructure spending. I mean, you can think about, it's a separate discussion, but you can think about quasi fiscal channels like NAPFID and so on to carry on your infrastructure spending. So we are not really worried about India's savings being able to fund the infrastructure cycle, but we think that the government's role in doing that any further, given where the fiscal situation is pretty much behind us, and the private sector or the quasi-fiscal or the quasi-government sector has to take up the baton from here.
Got it. Okay. Well, telling points, and therefore we do hope, and I'm sure you do too, that this piece, coupled with all the other actions that have been taken, do lead to the desired growth numbers. Santu, thanks so much for joining us. Like I said, I veered off script maybe, but there's such an interesting points that you mentioned that I had to ask the follow-ups on that. But thanks for joining in today.